But maybe we can start with the why. Like, why do you think the market is so much more important than the property itself?
Most people do think about the property they want. I want to get a 3-bedroom, 2-bathroom house. I want to get a retail strip mall. I want to get a 200-unit apartment building. And that's all good. Without the property, there is no financial performance. But the mistake you make is not paying enough attention to the market and to the team involved. And so you end up with a property that seems like a bargain. And in the end, it doesn't work out that way because of these other missing pieces.
All right. Well, welcome back to the Real Estate Syndicator Live, episode 25. And super excited to have my good friend, Robert Helms, in the house from the Real Estate Guys. Probably needs no introduction in this group. But I will say that he is the host of the longest running real estate show, I think, since 2007. Is that right, Robert?
Even before that, 1997.
1997. So co-host of the Real Estate Guys, started off as a radio show, no podcast, and now it's turned into one of the most downloaded podcasts in the country. And what's interesting that most people sometimes don't know is that Robert doesn't actually make a living from the podcast. He actually has a real job and he's a real estate investor. You don't actually make your wealth from podcasts, but obviously a super successful real estate investor in his own right. Most of you guys know his most sort of the biggest project that he has down in Belize, the biggest resort in the country of Belize, big time developer, big time real estate investor. And super excited to have him today because I wanted to talk about something that's super, super important that nobody talks about. And that is the market due diligence. I literally was telling Robert offline before we came on that in preparation for this, I was Googling, it's been so long since I've looked into this from his great course that he used to do. And so I Googled market due diligence, and guess how many hits I got from market due diligence? 0. Nobody talks about this stuff. Robert, you've always told me that there's no money in it, so nobody does it. You used to do an amazing 2-day seminar, a live seminar where you spoke the whole day on market due diligence and a whole day on property due diligence. And I'm trying my best to convince him to bring that back at least one more time since it's so valuable. But real quick, if you missed last week's episode, we talked about Robert's 4 sort of pillars of successful real estate investing, which was the personal investment philosophy was like your number 1 pillar, followed by market, which is what we're going to talk about today, followed by the team, putting your team together. And the final piece number 4 is the property, right? So investment philosophy, market, team, property. Most people start focusing on the property first and really focus almost exclusively on the property. And Rob, you always teach us that that's the most interchangeable of the whole thing. It's much more important to have a team in place. It's much more important to have the market in place. But maybe we can start with the why. Like, why do you think the market is so much more important than the property itself?
Yeah, that's a great question. Most people do think about the property they want. I want to get a 3-bedroom, 2-bathroom house. I want to get a retail strip mall. I want to get a 200-unit apartment building. And that's all good. Without the property, there is no financial performance. So you have to have a property. But the mistake you make is not paying enough attention to the market and to the team involved. And so you end up with a property that seems like a bargain. And in the end, it doesn't work out that way because of these other missing pieces. So yeah, we do say, personal investment philosophy first. That's who you are. This might be easier if you're in speaker mode instead of gallery mode, by the way. I know you want to see everybody's face, but personal investment philosophy, that's who you are as an investor. What makes you different than your neighbor? Not everyone has the same resources or the same risk tolerance. And even if you're married, there's a really good chance that your partner doesn't share the exact same tolerances when it comes to real estate. So there's a whole exercise that we do along those lines. You could take time to do it. I'll tell you how to get that on an audio workshop for free if you're interested. But personal investment philosophy is who you are as an investor. Once you've figured that out, then you got to find a market or markets that can deliver on that kind of an investment philosophy. For instance, if you are an A-class, hands-off, beautiful property, no drama investor, then there's certain markets that you would consider and other markets that aren't going to be suited for you. So once you know who you are as an investor, then your mission is to figure out markets. Once you find a market or markets, now you have to assemble a team. The team is critical. Now, who's the team? That's everybody from your broker, lenders, CPA, handy people, contractors, everyone that you need, not only to facilitate the transaction, but to continue the operation of the property. And I'll just say, Mauricio, that I will always err with a lesser market and a better team over a better market and a lesser team. Because at the end of the day, the rubber meets the road with the team. It's a critical part, especially of long distance investing. And once you've figured out the philosophy, market, and team, well, then it's time to buy a property. And you're right. I think that is the least important and most interchangeable part. But if you don't do the other stuff right first, you're going to buy the wrong property. If you take the time to go through all of the previous steps, then there's an excellent chance you're going to end up with the right property for you.
Yeah, and actually, it's interesting that you said the team. You'd much rather have a better team than in a lesser market, and that's the same thing with most of us here are syndicators. But we talked about it on our last show together on the Real Estate Guys show that when you're a syndicator, if you're a passive investor and you're looking at the deal, the most important thing for you is the sponsor. Do they have the experience? Do they have the track record? Can they execute the business plan? And this is the same thing. Do you have a team of property managers, right? Do you have a team of brokers, mortgage brokers, property brokers, attorneys, local attorneys that you can actually execute once you actually find the property? So that's really, really important. So let's talk about it. Because again, I was Googling around. Everybody knows market's important. In fact, I would argue that a lot of people over the last few years have been bailed out because they just happen to be in a great market. But as I was was just glowing a little bit today on social media that, you have this uncanny ability to find markets before everybody else finds them. I was remembering, I think when you and I both met, I don't know, 20 something years ago, you were really hot into the Sacramento, California market. I think you led everybody in the Sacramento market before anybody knew where that was. And then the following years, you led everybody into the Las Vegas market before the Las Vegas market blew up, and Belize and so on and so on. So I want you to share sort of the secret sauce with everyone, because everybody wants to, and I think people recognize the importance of it, but there's just nothing out there until I convince you to bring back your due diligence seminar. But talk about some of the things. I mean, I know, for example, jobs, right? I always think of jobs as probably, if not the most important, one of the most important factors that drive markets. Can you talk about a little bit about it, if that's true, and how jobs comes into your analysis?
Well, the reason jobs are important is that people will move to follow a paycheck. And they get relocated all the time. People that work for big companies move around. People that are in certain industries, like in the hotel industry, you typically don't get to be taken from assistant restaurant manager to restaurant manager at the same property. They move you to another property. Could be in the same town, but often isn't. Radio's like that. The joke in radio is you got to sleep with your suitcase in the front closet in case another station, a better station, calls you. And people in that profession move around a lot. So I think that jobs are critical. They're not the only thing that matters. And so if we step back for a minute, what gives real estate value is proximity to people. Proximity to people. You know where land is cheap? Rural Arkansas. Cheap. It was cheap 20 years ago. It was cheap 50 years ago. It's cheap now. I'm guessing 10, 20, 30 years from now, it's going to be cheap. We don't want cheap real estate. There's no demand for it because it's in the middle of nowhere. Maybe it's not the end of the world, but you can see it from there. So value to real estate is driven by people. Therefore, we want there to be lots of reasons for people to move and stay and work in a marketplace. So jobs are obviously critical, but there's markets like Palm Springs and Boca Raton that are retirement markets that are valid and vibrant. But it comes down to just a couple of things. And so I think the big picture is this: everywhere on the planet, but whatever country you're in, I'm going to guess most people are in the US. So every single city and every single state, every single day, people are moving into and they're moving out of. And so the big puzzle to solve is to figure out which are the places that have more people moving to than moving out. We call it net in-migration. Net in-migration refers to more people going into a market than leaving. And so how we get that information we can talk about, but the idea is not all markets are the same. You definitely have markets where there are just more people moving, and they'll move for jobs and they'll move for family, but they're packing up and moving somewhere. So your mission as a real estate investor is to figure out where exactly are these people moving. Now, I'll share with you some information. I don't want you to get caught up in the weeds. Like, I could do a presentation like this with just page after page after page of charts, like I used to do in the old days with the analyzing properties and markets to due diligence process workshop, which Maybe we'll do one last time.
Come on, let's do it.
But I'll share with you a chart that will illustrate this to at least a big level, a 30,000 foot view. Take a look at this. These are the fastest growing states in America right now. So the darker the state is in red, the faster the state is growing. So it's not surprising to see that Florida and Texas and Arizona and Nevada and Idaho are growing states. A lot of buzz around some of those markets within those states. And then you can see the dark blue markets are places where people are leaving. So number one, Idaho, number two, Utah, number three, Texas, number four, Nevada. You can see on the right-hand side of your screen. So if you did nothing else but restrict yourself to investing in those 10 states, you would be ahead of most investors. And that's not what I'm recommending. I'm not saying, pick one out of those 10. What I'm saying is that every market experiences growth. Now, that's the first step. It doesn't mean there's a growth of tenant demand. Most likely there would be in these cases, but that would be the next thing to figure out. So the process of market analysis starts with value of real estate is determined by people who live near it. And that's true whether it's vacation property or industrial property or even transportation property. A bunch of us spent the weekend in Jacksonville and Ocala, Florida this last weekend. It was a real estate guy's field trip, and we went there to see what the drivers were. And that's a growing market, and jobs are increasing, and house prices are going up, and it hasn't slowed as many markets have. So it's like, why is that? Well, there's a plethora of factors. And so rather than talk about any specific market, the big picture, I think, is to understand that it's not distributed equally. There are some markets where people are leaving, and there's some markets where people are standing in line to go.
Yep. And that's great stuff. And a couple of follow-ups on that. And by the way, guys, if you have a specific question, remember the whole idea here is for you guys to have access and ask questions. Just put your question in the chat. And I've got a few more that I want to ask it, but then I'd love to turn it over to you guys. You talk about, Robert, all the time about when you're doing your analysis with properties, you're always comparing one state with the other, right? Can you talk a little bit about that? Because I think people get caught up in, hey, I want to go to Jacksonville, and we can talk about Jacksonville in a second too. But talk about the idea that you're really looking to pick 2 or 3 markets and then do a comparison, right? That's kind of the way you've always taught us.
Yeah, it's always compared to what? So a market by itself, you don't know if it's any good until you compare it to another market. I used to teach appraisal at the college level, and I had a gal come up one night and she said, "You'll be glad to know that I'm researching 18 different real estate markets right now." And I said, "You're wasting your time." And she looked at me like, "That's not what I expect you to say, but here's what I believe. I believe you can only really know about a half a dozen markets well enough to make a great investment decision." Meaning if you pick a market or two and you do the research, and we'll talk about how you do some of that research before we're done, I'm sure, and you get it compared to what, and then you make a decision, okay, based on everything I've looked at, I think market B is going to be better for me than market A. That's the market you pick. Then a great little exercise is to pick a third market and compare it to the market you chose. Now, you don't want to do this through 100 markets. And so you want to start with a short list. I already gave you one short list. There's other lists of, like I'll show you another one here in a minute that people are thinking about when they're deciding where they want to own investment property. But once you can narrow it down, then you have to have a comparison. If you've ever gone shopping on a site for computers or something, it allows you to, compare 3 or 4 different ones side by side, and then lists everything. You can say, all right, this is how much, storage they have, and this is how much RAM they have, and so on. So you want to compare a market you're considering to another market that either you're already invested in, or if you're brand new, a market that you've heard is a strong market, or your friends are telling you is a great real estate market. And that's how you can expand. And I guess the first question is, why would you want to do that? If you're in a market and it's working great, why change it? Well, the answer is all your eggs in one basket is a strategy, right? That's the old idea of putting all your eggs in one basket and watching the basket. But the problem is if that basket doesn't work out from a market perspective, now you may be in trouble. So a way we diversify isn't by investing in all kinds of different asset classes, but by investing in more than one market. Markets have characteristics. They have a feel. I'm a big fan of going to a market once you've done the research for 4 or 5 days and kicking the dirt, looking around, talking to folks, getting the anecdotal stories, meeting with movers and shakers, but making sure that you're really understanding what's under the hood in a marketplace.
Yeah, I was going to ask you about it. Yeah, you mentioned I know you're well known for putting together field trips to actually go kick the dirt in markets, and I wanted to ask whether you thought that was critical, but it sounds like it is. So let's assume you've got a fairly new person. They don't know much about markets. They've got a couple of markets. Walk us through the process. Like, let's get practical, right? What's the first thing you would do? Let's say Mauricio came to you and said, hey, somebody was talking about Raleigh, North Carolina, and you're like, well, I don't know much about Raleigh. What would be sort of step one that you would do to start finding a little bit of information about a particular market?
Yeah, great question. So I'll give you a resource that's free. It's actually not free, but it's free to you and you're already paying for it. So I'll tell you about that in a second. But the premise is that we want to know who's moving there. So we talked about jobs. Jobs are one of the easiest things to find out about, but it's not just the number of jobs or job growth, it's job diversity. So I like to say that markets have stories, and every market has a story. So I make my home in Dallas, Texas. We have stories here. We have tremendous medical infrastructure. That's a story. We have incredible, large, and diversified universities. That's a story. We have professional sports teams in football, baseball, hockey, basketball. Those are all stories. We have distribution. We have manufacturing. We have one of the largest airports, right? Each one of those is a story that gives the market some color. And so you want to find a market that has multiple stories. You might see a market where demand is strong, but there's only one industry. Well, that's a challenge. That's what's happened to the Bakken years ago, is everyone said, wow, look how fast this market's growing. People are sleeping in RVs. They're bringing in buses. It's crazy. We need more housing. Except it was a one-trick story. There was only one thing going on, and it was a temporary thing.
Right.
So there's folks that decided to build apartment buildings there that are now not doing very well. So you want to make sure there's diversity. So the website I would suggest you go to is bls.gov. That's the Bureau of Labor Statistics, bls.gov. It's a little more intuitive than it used to be, but it's not super user-friendly. But what you can do is you can drill down to what the main industries in any market are. You'll see trends in terms of employment when you hear the national headlines that there's this many jobs this week and this many, new companies and so forth. That's where they get a lot of that information. So it's a very complex website, but it's easy to navigate once you learn your way around. So bls.gov will get you the big picture on an MSA, a metropolitan statistical area, a large part of real estate, if you will. Now you've got to drill down from there, but it's a great start. And in the due diligence class, we would show a couple of markets side by side, one that had good jobs, but not a lot of diversity between industry, and one that had the opposite. And so I just am a fan of having lots of different reasons why people would want to move there, live there, work there, vacation there, and so on. But that's a great resource. So to your question, one of the first things to do is to get your arms around what does growth look like from a population level, and who's coming and why.
Yeah. And let's drill down on that a little bit, because a lot of people are asking in the chat actually already, which is, how do you actually, we should probably have started that with some definition, but how are you actually defining a market? Is that a city? Is that a state? The Tenny who's asking about Raleigh, he likes Raleigh more than Fayetteville, North Carolina. Those are both in the North Carolina market. How deep do you drill? We always talk about real estate being a local. There's no such thing as the real estate market. It's real estate is local. What are you comparing? Are you comparing a city, a street, a county? Like how nitty gritty do you get down on the drilling?
Yeah, well, you have to start with the bigger market, but ultimately the bigger market doesn't mean anything. How's the market in Las Vegas, Nevada? Well, that's just way too big of an area to answer the question about. Did you mean the industrial market in North Las Vegas, or did you mean the residential market in Summerlin, or were you talking about the retail market out at Lake Las Vegas, right? But you have to start big picture view, because that's where the best data is available. So if you were to go to bls.gov, it doesn't drill down to neighborhood. It drills down to a large enough area for you to get a clue around. So let's take that as an example. We discovered that it looks like job growth is good in Texas. Okay, Texas job growth is good. We saw more people are moving into Texas. It's been one of the top job creators for a long time. Okay, that's a great start, but Texas is huge. San Antonio is not Austin, is not Houston, right? You just have to find a market. Even Dallas, Fort Worth, there's so many sub-markets. So you start with the big market and you drill down. If the premise is there is great distribution, there is great education, there are great financial services companies. Okay, now you want to know, well, where exactly? Where are the hot zip codes? Where do people want to move? And sometimes you have to reach out. I like apartment associations for this data because they drill down a little further. And, even if you're not thinking about investing in apartments, the apartment associations accumulate a lot of great data. Another great source for data that you wouldn't think about necessarily is a local chamber of commerce. The Chamber of Commerce does not have a dog in the real estate fight. They aren't real estate people, but what they are is a group of business people trying to encourage businesses to come into a marketplace. So they know all the talking points for the market, which would be good for you to know, but they also know who's coming or who's thinking about coming. They're not always going to tell you that, but if you get in a good relationship with someone, you can learn about the industries, about the big companies, about campuses being built, all of that. If there's a new campus and they're creating 2,500 jobs, is it possible that there's a housing need around those jobs, right? So you start big picture and you drill down. Ultimately, real estate purchase decisions are made on the block by block, street by street basis. Think about the town or market the very best. I bet if I were to go with you in that town, you'd be able to take me down a street and say, okay, anything on this side of the street, stay away from. But if you turn left here and go on this side of the street, it gets better and better. Right? You have that local market knowledge because you've been in the market a long time. Well, if you're investing from far away, if you don't have that knowledge, you got to find someone who does. So you start at the big picture and you drill down to the neighborhood.
Yeah, I've been listening to a lot to our good friend George Gammon, who, as you know, invests a lot in Medellin, Colombia, and he says the same thing. It's like, if you just go to Medellin without knowing what you're doing, you're going to get crushed because you don't know that this side of the street is where this happens, and that side of the street, there's gangbangers or this or whatever it is, and so it's super important to do that. Okay, so and by the way, the other story I was remembering, you were always remembering those stories about the college campus up north. I forget what campus it was, but a lot of people were investing in Northern California because there was like one college that arrived and everybody was gun ho. But like you mentioned, that's just one story. And usually you need what? Like at least 3 or 4 solid stories there, not just you need like a 3 wooden stool.
Yep. You want at least 3, and the more, the better. The more reasons, the better. That's what gives vibrancy to a market. So there's one other thing we should talk about, and that's a concept that's called cones. So what's a cone? A cone is an industry or company that brings business and jobs and money from outside a marketplace inside. So think of these as primary jobs, right? Does a specialty hospital bring money in from outside its immediate neighborhood? People will travel from different states, even different countries, to go to the Summers Hospital. So yes, do the Dallas Cowboys, like them or hate them, do they bring in jobs and money from outside of the area? Well, every week they play, they do, right? People from the other team come in. So those are cones. Industries are cones. Now, the reason that's important as a distinction is those are primary jobs. Imagine the local dry cleaner. Is that a cone? It's not a cone. Nobody relocates to a market because they have the best dry cleaner. What the dry cleaning job is, like the coffee shop, like shoe repair, are all tertiary jobs that support people that are living in the area. They are jobs. They do count. People that work at those places do rent homes and apartments. So it's important, but we want to understand where are the primary drivers in a market. And what we like as far as drivers are what we call sustainable drivers. Reasons that year after year after year, people move and stay in an area. Not, Cirque du Soleil that comes into town for 10 weeks, that brings jobs into an area for 10 weeks. So maybe you make, you rent out some apartments, but that's not going to last. Sustainable drivers are the ones that continue on and have a likelihood. Now, nobody has a crystal ball, right? If you had tenants that worked in the restaurant industry or the fitness industry at the beginning of COVID, well, all of a sudden they were out of job. But the more diverse your tenant base was in 2020, the better you probably weathered that storms. That's why I'm a big fan of diversity when we talk about real estate. Who is a candidate to live in my rental unit? I want that to be a long list of people.
That's great. And Alan's asking, would you consider climate one of those sustainable drivers? Is that where?
Yeah, that's a great question. Yeah. Climate for sure. Now, climate isn't what I mean, that's different for everybody, right? So there are places where the climate is beautiful, wonderful, fabulous, but it's not just, oh, the weather's tepid. It's what do people like to do? So there are seasonal towns, ski resort towns. They can be beautiful in the summer, but they do their revenue in the winter. Sometimes those type of markets are too seasonal to have a good real estate income that's solid. So if you have people that are moving in, moving out, even university towns are like that. In some places, the students are going to move over the summer. In other places, they're going to keep their apartment over the summer because they know if they give it up, they're not going to get it back. So those are some of the nuances between, but absolutely, that's a great example. People will, all things being equal, go to where the weather's nice.
Yeah, that's why I'm where I'm. That's the only reason I'm where I am, is So you're starting with your BLS.com. That's kind of our first step. The last step we talked about is kicking the tires. What are we missing in between? After I've gone to BLS and looked at some of these resources, the Chamber of Commerce, what's next on my practical steps that I should be looking at?
Yeah. So I guess maybe it depends on where you've started. So we narrowed down our choices a little bit at the beginning by talking about places that are growing compared to places that aren't. If you look at a market that is hemorrhaging people, where more people are leaving than coming, that just probably is not the best set of circumstances for a landlord to do well over time through either the long-term production of income or the appreciation of the asset. So that'd be one way to narrow your focus. Another is, where are the states that are business friendly, and specifically tenant landlord law? Some U.S. states are a lot more forgiving of landlords and some are more forgiving of tenants. So here's a map of the renter-friendly versus landlord-friendly states. So here, the more red the state is, the more landlord-friendly it is. The more blue the state is, the more tenant-friendly it is. So if I'm a tenant, I think I'm going to Nebraska or California or New York. But if I'm a landlord, I'm probably going to want to consider Georgia or Florida or Texas. So it really... That's another big distinction, is how landlord friendly a place is. So before I just put anywhere on the map as my potential, I'm going to narrow it down by things like that. And so we can start by looking at where the top 10 cities or markets for job growth. Okay, that's a great place to start. Then I look at the top 10 markets ranked for quality of life. Okay, then I can look at a chart at the top 10 markets for affordability. And if I start to layer these on top of each other, I see some patterns. Then I drill down into BLS.gov. I see what the jobs are. I start to look locally. Now my next job is to really get local. I'm probably going to reach out either via email or phone to start, and ultimately go to the market and talk to the local people in the market. Specifically, as much as I love real estate brokers, I love them, but a real estate broker will say, oh yeah, this house, gosh, $1,250 easy. And then you talk to a property manager that goes, $975, right? Salespeople will puff up a little bit, and they aren't the ones that are responsible for getting the units rented. So my favorite team member to start with is a property manager. Property manager isn't going to blow smoke. They're not going to tell you they can do better than they can, because they have to live with that salesmanship, if you will. So what a property manager can tell you is not just what going rents are, but what's in vogue. What do people want right now? Are more people interested in homes than apartments? Are more people interested in 1 bedroom than 3 bedrooms? What are the trends? And it's amazing how much especially bigger property managers, nothing wrong with the, one woman or one man band who has, 14 houses they manage. But we were just with a property manager over the weekend that has 2,000 houses in about a half a dozen markets. Okay, that's a pretty big perspective. And if you ask those folks, hey, what's your hottest market? Where do you have a lot of demand and not enough supply? They're going to know the answer to that. So as you're getting more and more specific, that's when you need a boots on the ground team.
Where does, and I hesitate to even say this, but where does politics fit into this? Because as most people know, the real estate guys, apolitical, same with Premier Law Group. But it seems to me like, compared to how it was when you were doing the seminar, that we've become a little bit more political in the last several years. And so there's a couple of questions about, for example, and again, we're not going to get into the politics of it, but things like, Roe v. Wade and that whole thing, and, Second Amendment stuff. And even somebody was asking about just in general, whether you're a red state or a blue state, or doesn't matter what side you're on, but political affiliation. Is that something that you are seeing more of and would put that a little bit more weight than you would have, 10, 15 years ago?
Well, yes and no. Yes, in that the answers to those kinds of questions might give you some clues as to what properties would be beneficial to consider. The no is that the politics itself doesn't matter. What matters is the policy. So there's great investment opportunities virtually everywhere if you look hard enough. But one of the things that comes up when we talk about tenant friendly versus landlord friendly states, if you wanted to look at this map, you might see that the bluer means rental friendly, but the bluer is also maybe more liberal, and the darker red is maybe more conservative. Not 100%, but approximately. And so, again, not political at all, but I like to go where my money is loved and appreciated. And I think places that are business friendly, that have extended a hand to businesses, encouraged growth of businesses, not burdened businesses with unnecessary steps and taxes and processes, are places that are going to make better sense just from a pure investment point of view. One of the great case studies we have is the pandemic. So whatever you think about that, I don't know why wearing a mask became political. Like, that's just a personal health choice, but it somehow did. But what we do have is a 2-year case study of how markets and how economies, local economies, did based on their local government's decisions. So that is just great information for us to glean. Now that we've been through that weird time in our history, it gives us some insight into how different markets might react in the future to those kind of things. So while I don't think politics has much to do with real estate, with the exception of maybe rent control, right? If there's an area, and that's usually a local phenomenon, not even a statewide phenomenon, a couple states, but for most parts, it's local. If some government agency restricts how much I can ask my tenant to rent a property, or how often I can make an increase in the demand on the tenant based on what's happening in the market, then that's going to artificially lower my rent, which artificially lowers the value of my building. Personally, I'm not interested in that. So I generally don't invest in places that have rent control. That's just one shortcut. Now, that's not a magic rule. It's just, how is politics going to affect me as a landlord? And I'd like to be in a place where it can be shown to me that the local government is very much in favor of folks coming in and buying rental property.
Yeah, our good friend Brad Sumrock, who's actually going to be at our event, or I keep calling it our event, your event next month. He always has this sort of annual, top markets to be in, and I know that's one of his big cutoffs, right? Is it a landlord friendly, or is it a tenant friendly? He doesn't want to do any business, and you don't want to do any business really, or the deal just has to make so much sense for you to be in a sort of in a tenant friendly state. Our good friend Sep Beckham is in here. Hey, Sep. He asked, do you think some markets will be more resilient to interest rate increases and others more susceptible? And what local market factors would play into this?
Yeah, that's a good question. And if you want a good question, ask Sep. He usually has one. So let's face it, interest rates are up. This is concerning for folks, right? And does an interest rate increase affect all markets equally? And the answer is it doesn't. There are markets where tenants will literally move over a $25 rent increase. And you and I look at that and go, man, it wouldn't affect me if my mortgage changed by $500 or $1,000. I'm not moving over it, but you are not your tenant. Tenants will in some markets. And so the markets that are going to be more resilient are going to be the markets that have better quality job growth. So the right kind of jobs with the right kind of pay, that's going to make a big part of it. As we're looking to acquire property when interest rates are up, everybody has to sharpen their pencil. There isn't the same margin that we once had. So we have to make a decision. Either we sit out the market or we figure out how to make it work with higher interest rates. I'm going to be a big proponent of that, because debt is how we short the dollar. and the dollar's been declining steadily for 100 years with no end in sight. The US dollar has lost 95% of its value beyond the top of our discussion today. But if that's true, and we can prove to you that it is, then what happens in terms of the financial durability is not the same in every market. So because of that, I'm not going to be in the lowest of low-end markets. Sorry, Sep. When we talk about resiliency of a market, there are markets across America that seem to bounce back faster after any sort of negative, the great financial crisis, the pandemic, on and on and on, than others. And that's because they have a variety of these durability factors. And I think that's critical too. If my mindset is, I want to get married to a market, I'm going to pick a real estate market or two or three, and I'm going to continue to invest there. I'm going to build up my real estate portfolio in those areas. Then I'm going to look carefully at those kinds of things. If, on the other hand, I'm a real estate flipper, I just get in, do some work to change the value and get out, well, then the market maybe is a little less important, as long as there are people who are demanding the finished product that I'm creating. So it really is your investment horizon feeds into this question. But I would say for sure it's not going to be equal. And there are places where you're going to see the increase of interest rates affect markets harder than other places.
Great answer. Great answer. I've got a question from Ashley Wilson. Ashley jumped on last week's live and really provided a lot of value. She's also joining us for our Bethany's retreat next in a couple months. So Ashley, you want to come on and ask her? You've got a little bit of a detail about states flipping based on landlord friendliness. Do you want to pop in, or do you want me to read it?
Yeah. Thank you again, Mauricio, for pulling me in. And of course, Robert, you're always so much wisdom. I just wanted to kind of get your take on this. Looking at the two maps that you showed with respect to kind of the layering principle, when you look at migration patterns and you look at where migration is originating from, a lot of the migration is originating from historically blue states and migrating to historically red states. So my question is with respect to policy following quickly after and flipping those states from historically landlord-friendly states to tenant-friendly states and vice versa, and what that horizon looks like, because I think that is something that we will be seeing, at least what I believe we'll be seeing 5 years or less, I think.
Yeah, that's a great point, Ashley, to think about this. If people are fleeing states based on the policies that were derived from the politicians to go to new places, but they were the very people that voted in those politicians and think that way, then how long before they pollute, I'll say it, the new state, right? And it could go both ways. It's not about red or blue. It's just wherever I am. Rick Perry, who was the former governor of the state of Texas, wrote a great book. And in his book, he made the case that the 50 states all have very different ideology, culture, history, legacy. And his example is, he says, if you want to carry a gun openly, well, then go to a state like Texas. If you want bathrooms that come in 5 different flavors, then you should go to California, right? It's not right or wrong. How people believe is how people believe, but they tend to vote with their feet, and they go to different areas for different reasons. California, right? Net out migration. Why is that? Well, it's not just because of politics or policy. It's because pricing has pushed people out. People have left that market because the average, in fact, let me show you one more kind of fun. This will be hard to read, but Russ Gray gave this to me on Saturday. This is the salary needed to buy a home in 50 US metros. Now, I know it's tiny and hard to see. You can get it at visualcapitalist.com, but it shows you markets like the San Francisco Bay Area, where the average person to buy the median home has to make $300,000. In Jacksonville, Florida, it's more like $70,000. So if you have to make $330,000 just to buy the median house, it's not long before you say, you know, I love looking at the ocean, but there's some other places I could go. So that's one of the reasons that people move. And so we're definitely seeing a change in the political landscape every time somebody moves, but not as much as you might think. right? I don't lay awake at night worried about the markets I'm in that are very landlord friendly turning the other way quickly, because the ideology that permeates there has been there for a while. So could it change over time? Absolutely. And real estate's a long-term investment. It's why you want to get involved at the local level in your apartment association with your local politicians, right? The real estate owners have a lot of power. We create a lot of income and we create jobs and all those things. And so it's something you want to pay attention to. And there will always be more tenants than landlords. Always, always, always. So because of that, tenants' rights organizations and unions and things like that will try to exhibit their power. So you just want to go to places where that's been tried and failed. So I would pay attention to it, but I wouldn't worry or dwell on it.
And it starts slowly, right? I mean, I used to live in Austin, Texas, and I believe Austin's kind of starting to flip. But so you think of Texas and you think of it as a certain way, but Austin's starting to become the opposite. And I guess it just starts, and probably the same thing in the Phoenix market. There's some pockets of Phoenix that are starting to go there. So, all right, I got a couple more because I want to respect your time, Robert. I really, really appreciate you sticking around. I'm going to share. I'll figure it out. I'll share the slides. Some people have been asking for the slides, so I'll put a copy of that probably in the Facebook group. And then there's somebody asked a question about a 1031 into a syndication. I'll answer that once Robert gets off. I'm happy to answer that. Kind of a long one, but maybe this will be the last one. So Tenny asks, how would you weigh a tertiary market that's, let's say, 45 minutes outside of a major market? For instance, I have a property we may purchase in Texas City and another one in Liberty, Texas, which are both in the Houston MSA. So the Houston MSA is phenomenal for job growth and all indications are all systems go. However, how do we know if people commute to that MSA for work?
Great question. So market size matters. In fact, real estate investment trusts, insurance companies, pension funds tend to only invest in the top 50 MSAs, some only in the top 20 MSAs. So think about this. These are really smart, really wealthy people who represent the business and financial interests of even smarter, even wealthier people. And they put hundreds of millions of dollars to work. And they've decided right off the bat, one of the easiest ways to just figure out the whole thing is to only take the top 20 markets by population. So there's some wisdom in that. Now, here's the old joke. If you invest for income, cash flow, then you want to tell everybody about the markets that you're in, right? I'm sorry, other way around. If you invest for cash flow, you don't want to tell anybody about the markets you invest in, because as soon as they come in to invest in those markets, the price goes up and the properties don't perform anymore. But you invest for appreciation, you invest to speculate, then you want to tell everybody about the market, right? So everybody comes in and drives the price up. But the tertiary market is a really interesting market. My experience is that all things being equal, I'm not going to pick a market like that. And here's why. The A list of plumbers, property managers, CPAs, cost segregation experts, the A list doesn't live in those places. Some won't even go to those places. How long is the list of competent third-party managers in a city of 10,000? Not very long. So I'm not going to say there's never an opportunity to invest in a tertiary market. I'm just saying you got to be a lot more careful. Also, the number of stories, cones, drivers is going to be really limited there. So people are attracted to those markets because they're inexpensive. And again, think of rural Arkansas. They're likely to stay that way.
Great answer. Hey, listen, before we go, I do want to talk and have you talk a little bit about, one of my, if not my favorite, one of my favorite events. You've got so many of them, but next month we're all getting together for the Secrets of Successful Syndication. And for those of you who don't know about it, Robert, you want to tell them why they should be showing up? It's going to be September 16th and 17th. I'm going to be there. Sep's going to be there. A lot of people on this live is going to be there. But if you're a syndicator and you haven't been, Robert, why don't you tell folks why it might be a good idea for them to at least take a look at it?
Yeah, or if you're not a syndicator yet, or you want to invest passively in syndications. I think for us, the real estate guys, we talk a lot about real estate syndication because I think it's the very best job opportunity, business opportunity, entrepreneurial opportunity in real estate. If you invest in your own account, one day you're going to run out of resources. You're going to run out of your money. You're going to run out of your qualification. You're going to Fannie and Freddie out. But if you'll just put together deals using that expertise that you have gleaned from working already in a marketplace with a team, and if you had more money, you could do more deals, then syndication is for you. Twice a year, we do the Secrets of Successful Syndication. It's 2 days of awesomeness. And what's great about it is the content is really good. Okay, Mauricio is going to teach us all about securities law, but he's not the only attorney there. We're going to have at least 2 more attorneys on stage, one of which Mauricio introduced me to. He's an estate planning and asset protection attorney, and that's going to be an awesome session. And then we've got an attorney who is in his 90s who has done thousands of real estate transactions. His name is George Ross. He's going to be with us. Incredible attorney. He was Donald Trump's personal attorney for 47 years, his business attorney, but he did 700 real estate transactions in Manhattan before he ever met Donald Trump. This guy is sharp. And even though he's 90 something, his brain seems like it's 21 because he is a great guy. You're going to dig him. But the whole idea of the syndication workshop is to learn maybe some things that you haven't yet, but even more importantly, to network with hundreds of other syndicators. It is so humbling when we stand on stage the first day and ask, hey, who already owns investment property? And it's always 90% of the hands, if not more. It's not a beginner's seminar. It's not any of that stuff. It really is a great place to meet other people in your industry who have an abundant mindset and not a scarcity mindset. And it's coming up in the middle of September. We'd love to have you there.
Yeah, it's September 16th, 17th. I put I'm more, Ben, thank you. I put the website up there, realestateguysradio.com. And then Ben, right below that, put the link in there, which is much better, right to the page of how to raise money for real estate investing. So hopefully you'll join me and Robert and Russ and Seth will be there, and Tom Wheelwright and Brad Sumrock and a lot of, and by the way, George is amazing. 90, is he 90 now?
Oh yeah, he's over 90.
He's like,
he might
90,
be 93 or 94.
It's crazy. And his mind is as sharp as probably Dennis Waitley's, who we saw a couple weeks ago. But anyway, Robert, thank you so much on behalf of the entire community. I know you're super busy, and for you to be able to take some time out of your busy schedule, really appreciate it. I'm going to stay on a little bit. There's a couple of questions I saw about 1031s into a syndication. And if you got any legal questions, then I'll stick around for another 10-15 minutes. But Robert, if everybody can give Robert a round of applause, and thank you for joining us, my friend. And we'll see you soon here.
Thanks, everybody. We'll see you on the radio.
Thanks, Robert. And thanks again. I'm going to stick around. Like I said, I did see a question. Hopefully that was valuable for you guys. Robert's just a class act and does this way better than I do. I always feel a little bit insecure when I'm interviewing him. But somebody asked a question about 1031ing into a syndication. And I want to make sure I find that one because where is it here? Whoever asked that question, do you want to just pop in there and ask it while I'm looking for it? There's a lot of questions we probably didn't get to. And while you're coming in, maybe it was Mary, I'll drop all of these links in the Facebook group. I put the link down there as well. If you're not a member, mauriciorauld.com/FB group. We're all, actively involved in that group. Mary, were you the one that had the question about 1031? Or maybe not. Anyway, I know the question. I don't know who asked it, but the question was, can you 1031 from your real estate into a syndication? And we did a live about this because this is a hot topic. And the answer is yes, but not the way you would traditionally think about it. So with a 1031, as you should know, is that you have to do what's called a like kind exchange, meaning if you own title to real estate, you have to essentially you're exchanging that for another property that you have direct title to. Even though you're technically selling one and buying another, the IRS looks at it as a simple exchange of one property for another, and it has to be like kind. And the problem with the syndication, as you guys know, is that syndications are typically entities, LLCs. So what you cannot do is go from a property, owning a property, relinquishing the property, and then exchanging that for shares and membership units in an LLC. That's something you cannot do. It has to be exchanged for direct title. So how do we do that? The way we do that is we give you direct title. So if you have an investor, just for ease, let's just say there's $1 million worth of equity that's coming out of there. They would come in and they would own 10, 20, 30% of direct title to that new property alongside the syndication LLC that's raised all the additional property. Let's just say they've raised $3 million. So $3 million is the syndication LLC. $1 million is coming from the 1031. And so the two of them now become direct owners. So the syndication LLC owns making this up, 75% of the property, and then the 1031 investor owns direct title to the remaining 25%. And then we tie it all together with a tenants in common agreement, a TIC agreement, because obviously it's almost like the operating agreement, and they're not going to be a member of the LLC. So we have a TIC agreement that outlines all the rules that we're, who's going to be making the decisions, everything that you would see in an operating agreement. We put that into the tenants in common agreement. The main challenge from doing that, and people have been trying to come up with creative ways around this, but the limitation, the restriction that we have isn't from the security side or even technically the 1031 side. It comes from the tax side. So there are IRS restrictions. And if you go back to the live that we did on this topic, I think it was episode 3 or 4, you can find it on the YouTube channel, but there's 15 items that you've got to check off that are basically restrictions or rules that you've got to follow pursuant to the IRS. I believe it's IRS Revenue Procedure Code. I want to say it's 2002-22 or something like that. But the main ones are, for example, that the manager, you can't get basically paid from that 25%. Meaning you can't charge a carried interest on that 25%, which really limits the syndicator, right? So you can get paid, let's say you're doing a 70-30 split with your investors. You can do a 70-30 split on the 75% that's owned by the LLC, your syndication LLC, but you cannot do a split, a 70-30, 80-20 with that 1031 investor, because the distributions have to mirror, according to the IRS, have to mirror ownership. So once you pay all your fees, which we'll talk about in a second, but once you pay your fees, you pay your lender, you pay all the costs, whatever is available for distribution. If it's a 75-25 between the syndication LLC and the TIC member, you have to distribute the money 75% to the syndication LLC and 25% to the 1031 investor. You can't just give them a preferred return and then give them some other random distribution. That really limits you. You are allowed to take a reasonable acquisition fee, which is then proportionately paid for. So again, in my example, 75% of the acquisition fee gets paid by the syndication LLC and 25% gets paid by the investor. You can take a reasonable asset management fee, again, so long as it's proportionate, but you cannot do preferred returns to the 1031 investor. You cannot do carried interest and give them an 80-20 split or whatever, an 80-20 split or a 50-50 split. It has to mirror the percentage ownership. And so that really is almost like a deal killer for most, unless you're just super, if you're desperate to close and you just need the money at the end and you need to get them in, fine. But also remember, it's going to change the entire syndication. We're going to have to go redo all the documents, last minute. We've got to disclose that to the investors. Not to mention the risks, right? So if you have one TIC member, or certainly if you have 2 or 3 TIC members, some people do several of these, the challenge is that they have veto power. So there's a little bit more risk for the passive investors, because if you want to go sell this property and as the manager, you make the decision to sell or refinance, the TIC member is going to have veto power. I mean, even if you try and contract that away, the lender is going to insist that they have some voting rights. But at the end of the day, you're going to need them to sign on the transfer documents, right, in order to sell the property or the loan to sign that. And so if they, for whatever reason, don't want to do that, you're beholden to them a little bit. And then also just the 1031 risk in general, that if that thing blows up and there ends up being a tax problem, tax consequence, potentially they could come after the syndication LLC. And so we want to make sure that we're very clear, and we have letters from the CPAs and everybody just saying that they sign off on this. So anyway, I have heard, and actually we've handled some of these as well at the firm at Premier Law Group, where, and we don't structure these because it's usually a real estate attorney, but there have been some kind of creative ways to try and get around that with sort of, lease options and master tenant leases, and just kind of a weird way to kind of reverse engineer so that at the end of the day, the distributions match what you would have done ordinarily. We don't put those together. We just make the proper disclosures that, hey, nobody's really blessed this. It's not something that, we're signing off of. And most real estate attorneys will tell you, yeah, it might work 60, we don't know if it's going to work or not. They give us like a 70%, vote of confidence that if this were ever to get scrutinized, they think it's maybe a 70%, maybe a 2 to 1 chance of, or 3 to 1 chance that it's going to work out, or 2 to 1 chance it's going to work out. So anyway, lots of risk involved, but technically it can be done. It's just got a lot of restrictions due to the IRS Revenue Procedure Code. Hopefully that answered your question. I was going to have a long, convoluted answer, but I would definitely recommend going to, I think it's episode 4 or 5. We did a whole episode and we went through all the other 15 limitations that the IRS does. All right. If anybody wants to raise, why don't we just do the raise the hand stuff if you guys have a legal question? Lee, well, let's go with Lee. He's a first timer. So Lee, this is my first time on this webinar. It's been great value. What site can I go to and learn more? Oh, thank you. We don't have a site. My whole goal here is to just provide value. We've got a Facebook group, which is just on Facebook. It's called the Real Estate Syndicator Community. And I'll put that in. It's just Mauricio. You can either find it on Facebook or just go to mauriciorauld.com/FB group. But no agenda here other than just to maximize value to everyone. The Facebook group's really cool. Everybody's pretty active. I'm there all the time. So if you've got any questions for me that you didn't get a chance to ask today or follow-up questions for Robert, just pop in there and drop them in there. The more questions, the better for me in the group, and we'll be happy to answer them. And then we do these every Tuesdays, 4:30. The next one will be next week. And we've got actually Yona Weiss. I didn't want to make the announcement at the beginning just because I didn't want to take time away from Robert, but Yona Weiss, who's a cost segregation specialist, will be joining us, not next week, but I think the week after that. So excited to have him on the show. And yeah, if you want to raise your hand, I'll be happy to answer your questions. If not, we will probably see you next week. All right. Well, thanks everyone. I'll put the replay up again. I'll send an email out. If you're obviously on the email list, I'll send an email out with the replay. I'll get you the slides and drop those in the Facebook group. And appreciate you guys sticking around on a Tuesday evening, and we'll see you next week. Thanks, everyone.